Joining me from San Antonio, Texas today is Frank Holmes of U.S. Global Investors. Frank, welcome back to On the Spot.
Happy New Year.
And speaking of New Year, Frank, how are we seeing gold set up? We saw it struggle, especially after the U.S. jobs reports came out last week. How is it set up thus far this year?
Well, I think the big factor will be for that fear trade is inflation to show up or bond rates to come down. And what we have seen is this time last year is that investors were making a negative rate of return on their 10-year and government bonds. Now it's positive. It's positive because rates have gone up on the long end of the curve and inflation CPI numbers have come down. Whenever that takes place, it's usually challenging as a headwind for gold. I think in sometime in the next 12 months, we're going to see a reversal. We're going to start seeing that inflation basically pick up. And I think one of the key factors to look at is this PMI, the Purchasing Manufacturers Index. The global PMI still remains positive, and there's a high correlation to the global PMI and the demand for commodities and job creation.
So, Frank, how are ways that investors can look to make money in commodities?
Well, I think one has to take a look what the demand is in that cycle. What we're seeing is that there's an inventory buildup of platinum and palladium in the ETFs. They've been moving down in sympathy with gold, but interesting enough, car sales are huge, and there's a need for platinum palladium for cars. So I think that's a classic asset class to be investing in. Copper's another one. This is a classic asset class to be investing in. Now, what you are seeing, which is important, are takeovers. And you're seeing streamlining because the cost of being listed is so expensive, the regulatory costs. And so some of these companies are saying, we merge, we can save $3 million to $12 million a year. In addition, it can be accretive. So we're seeing also in the energy space, more so than the gold mining space or the metal space, we're seeing people like Carl Icahn going after Talisman to say it's better to break up that energy company. And we're seeing these stocks rise in price. We're seeing Petrobiola's consolidating Colombia by buying Petrominerales. So there are opportunities, and right now I'm a believer that the cheapest reserves, either mining or oil and gas, are listed. They're not in the ground.
So, Frank, you mentioned mergers and acquisitions, and we're seeing Goldcorp eyeing Osisko. Rob McEwen just announcing he's looking for some M&A activity. When you hear these stories, are you happy about it?
I am. I think it's a good way to clean up companies and people to focus. I think a lot of the cost of looking for an ounce of gold, a lot of cost for mining got so expensive, was pushing $1,700 an ounce. Now with gold at $1,250 range, you're seeing a huge contraction of spending. You're seeing rationalization, and I think you're going to see a slowdown in gold supply hitting the market in the next 2 years. And I think that's going to be a positive indicator. Now, one of the other headwinds to gold has been this love trade I've commented many times on. And what's important there is to track the GDP per capita of India and China. And basically, in particular, India has gone flat for the past 18 months, and that does impact the demand for gold. In addition to you having the government put on taxes and trying to make gold so much more expensive to buy, that has impacted the demand for gold going into India. I think that those things will probably reverse, and we're going to start seeing rising GDP per capita for Asia in the next 12 months.
Frank, moving from gold now to crude oil, in your December report, you said that U.S. crude oil production is on the rise, reaching 8 million barrels a day in December. That's a 25-year high. You also explained that in order for investors to benefit from this growth in oil and gas, they should be selective. What did you mean by this?
Yes, you want to look for those companies which are showing that top-line growth in revenue on a per share basis, and you're paying a low cash flow multiple. So we look at a universe right now, including big metals, etc., about 350 resource companies. And when we turn around and say, I just want the top half in revenue per growth, and I want the bottom half in cash flow per share that I'm paying for, I immediately come down to less than 100 stocks. And what's interesting is that companies like refineries show up. Refineries were the best performing energy industry sector last year in the S&P 500 and the year before. So you've had 2 years of spectacular run. Well, why is that? Well, America's finding so much oil and gas, and therefore the feedstock to create a gallon of gas is so much cheaper in America. We're paying here $4 for an MCF. In Europe, they've got to pay $11, $12. So chemicals, et cetera, are the cheapest being manufactured in the US. And that's what gives us big bargaining power.
Frank, my last question for you today is regarding the U.S. economy. There seems to be so much debate about whether the U.S. will recover or not this year and whether China is really on the U.S.'s heels or not. Now, as a Canadian living in the U.S., and I know you travel often to Asia, I'm interested to get your perspective on the U.S. at this moment.
Well, I see the U.S. is just a remarkable country, so resilient, and it'll slowly climb itself out of this recession. Years ago, when this whole drama took place, I said it takes about 4 years, based on 400 years of research, that you get this economic boom. But America's even more resilient, and I think that you're going to continue to see. But it's not going to be growth like we saw in 2005, 6, and 7. It's going to be much more modest. But we are going to continue to see this growth taking place in the U.S.
Should the U.S. be concerned about China's rise, Frank?
No, I think it's the global, all the countries of the world are all focused on this global PMI because it's the best way to look for job creation. The only country doesn't seem to get it right now when we look at Europe is France. You're seeing Spain gets it, you see England get it. A classic is countries like Spain drop the visas for Chinese and for Russian tourists, and luxury goods sales jump 38%. It's creating policies to attract the wealth that's being created around the world. And so I think that the global, what's really important for metals and resources as a whole is we have 7 billion people, and whenever you have that 1 month PMI growth as a global PMI that JP Morgan publishes is above the 12 months, it's very bullish. It's very solid grounds to be investing in the resource sector.
All right, Frank, that's all the time we have today. Thank you for being with us.
Great, take care.
And thanks for watching this edition of On the Spot. You can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Camboden. Thanks for watching.